if you're looking at this, what you're seeing is that we're maintaining this all-time high level. And every reason is out there for gold not to be doing great. The economy is very slow. Real rates are acting in a way that would normally predict for gold to be struggling. The yield curve is no longer inverting. It's now trying to reverse that. There's a lot of heavy things happening. And you would think gold would be weak during that time, but it's very strong. And I think we're going to move up to that 2150 to 2200 trading level by the middle of the year. I mean, this is something that I see happening by the middle of this year. I think there's other things we could talk about that are indicating that that's right, and that'll be our new little zone.
EBTucker, from the Tucker Letter, offers his insights into the gold market for the next 90 days, expressing confidence in the precious metal's current position. Tucker foresees a positive trajectory for gold, projecting that it will ascend to a trading range of $2,150 to $2,200 by the middle of the year. Gold prices are seen hovering around the $2,030 mark, experiencing a nearly 0.50% increase after a recent period of volatility. If the momentum persists, the potential next target for gold could be the $2,050 level. The focal point of attention is the upcoming decision by the Federal Reserve regarding interest rate hikes, with potential implications for gold prices. Adding to the optimistic outlook, senior commodity strategist Mike McGlone suggests that gold prices may experience a significant surge, potentially reaching $3,000 in 2024. Tucker observes that despite a sluggish economy and the behavior of real rates that would traditionally indicate challenges for gold, the precious metal has maintained its robust performance. The positive trend in gold prices has persisted since the beginning of the week. Coin Price Forecast anticipates a substantial increase in the price of gold during February. As of the latest update, the price of gold has experienced an uptick from the $2025 level. According to recent data from Investing, gold is trading at $2,027, reflecting a rise within the past 24 hours. Even in the face of the Federal Reserve's proactive tightening measures throughout the year, concerns about a potential recession linger. In such an economic climate, safe haven assets like gold continue to attract investors. Gold is an effective portfolio diversifier, mainly if risk-averse sentiments dominate the markets in the coming year. Tucker expresses skepticism about extreme predictions, such as gold reaching $10,000. They question the realism of such valuations, stating that it would imply an unrealistic gold value relative to the total assets in the world. Join us as we delve into insights shared by EBTucker. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
If you're looking at this, what you're seeing is that we're maintaining this all-time high level. And every reason is out there for gold not to be doing great. The economy is very slow. Real rates are acting in a way that would normally predict for gold to be struggling. The yield curve is no longer inverting. It's now trying to reverse that. There's a lot of heavy things happening. And you would think gold would be weak during that time, but it's very strong. And I think we're going to move up to that 2150 to 2200 trading level by the middle of the year. I mean, this is something that I see happening by the middle of this year. I think there's other things we could talk about that are indicating that that's right, and that'll be our new little zone to be in. But people need to make a choice. Like, there's two ways to play gold. One way to play it is you can buy it and own it, and you can kind of use it as a way to protect wealth, which is really hard to accumulate. And the second way is you can be a trader. And if you want to be a trader, these moves of 1%, up, 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 down, 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 like every single day the Fed says they're going to do something with rates. Oh, it's down. Oh, it's back up. It's just to get you in a spin cycle. But if you want to be a trader and you just want to trade it and you don't care about preserving wealth, you just want to play it, this is really good. But I've never been that interested in that because I feel like it kind of, at the end, you lose. I mean, you win the battle, you lose the war type thing. So I'm much more like I want to win the war. I don't really care about the little skirmish.
So you can do either. You just need to know who you are.
That's right.
And what you're doing.
This is the secret of life, right? Yeah. You got to do anything you want if you're honest with yourself. You say, this is what I do, So anyway, that's what you have to do with the gold market. So here's how I'm going to play it. Because people think it's going to go to like 10,000. Well, I mean, maybe, but like that would imply that the gold value in the world would be something like 50 trillion plus or something like that. It's like I don't know if that's really realistic. I mean, it doesn't really match with the rest of the assets that are around. It doesn't make any sense. And so I think what you see is that we're moving up. So we keep moving up in these little directions, and gold is like heavily traded. I mean, I watch it on the Bloomberg every day for decades now. And I mean, you'll trade in an active day, you'll trade half a year's worth of mine supply, and that real gold never touches that. But that's what sets the price. And people say, oh, it's manipulated. It's not really like that. It's not like manipulated. It's just highly financialized. It's a highly liquid market, and there's like tons of physical, tons of futures, tons of options on futures. I mean, it's like really, really moving all the time. And that's why when that move happened on a Sunday night, you broke into new highs when you saw it rip right back down. It's because there's a lot of money to be made in gaming those moves. And there's a lot of people doing it. And they're a little bit more active than if you're at home, using like a Quest trade account. It's like these guys are a little bit moving a little faster. So I mean, they got like hundreds of Bloomberg terminals and they're up all night in Asia. I mean, you met your match. But my point is that as we move to these levels, when you look back, it's like pretty obvious. I mean, this is like it's a pretty strong position the chart's in.
At a 2-day meeting that starts Tuesday, the Fed is expected to hold its key short-term rate steady at a 22-year high of 5.25% to 5.5% for a fourth straight meeting. Yet some economists think the Fed will begin lowering the benchmark rate as soon as March, and that means it could signal its intentions at this week's gathering. Tucker suggests that there is a common belief that the Federal Reserve might reverse its stance on interest rates. However, he argues that the specific rate set by the Fed might not be as crucial as the broader liquidity management strategy. Inflation has been coming down more rapidly than Fed officials anticipated following a pandemic-induced price spike, even as the economy and labor market have remained astonishingly resilient. Tucker dismisses the idea that the Fed is solely reacting to inflation or other economic indicators. Instead, he asserts that the Fed manages the economic system based on its internal goals and strategies. Let's get back to the interview.
So, I mean, I think everybody's like, the Fed's going to reverse their stance. But the thing is that they're not really, I think people misunderstand the rate that they set is not really that important. It's like they've set the rate at, say, 5.5, 5.25, 5.5. But the 2-year Treasury is substantially lower. The 10-year Treasury is even lower, right? So it's like, is the rate really matter? I mean, is that really what's going on here? What they've been doing is they've been draining the system of liquidity. That's what they've been doing. And so they use that rate to corral that money they printed. And you see it in the reverse repo market, and they've been pulling that out. It's down to $600 billion, started at $2.2 trillion. To make things simple, don't be thinking at home, this is too confusing. It's not. The balance sheet got to $9 trillion. It's 7.5 now. So it's exactly the same number. That's what's happening. They want to pull all that out. When are they going to do it? It's very easy. It's $90 billion per month. So by the summer, it'll be out. And that's why I say that I think the target will be hit in the summer, because as that gets down low, things will start rattling a little bit, and then they'll come with some new, it's a very managed system. Don't be thinking like they're in there studying inflation, trying to help you. This is a managed economic system. And it got a little hot a few years ago. So they had to dial it back. We're in the beginning of Q1. We just come out of we have the whole Chinese New Year happening now. We came out of the U.S. New Year, Western New Year. I mean, you have this periods of like, what's everybody doing? I mean, you hit an all-time high, and it's one of these times where like, everything's trying to settle. This is not normally a time when you take a big position. And so I think what you'll see as this quarter drags on is that there's a lot of things that are getting very tense. I mean, there's a story last week where Blackstone quit paying the mortgage on a office on Broadway, not their office, but an investment property, and the loans being sold for 50 cents on the dollar. I mean, all this stuff is starting to like build up. You're starting to see all this, and then that's at the same time going on with the U.S. Election cycle, which gets things very tense in the U.S. We do a real street brawl is what we do for the actual cycle of presidential nominees. But basically, all this stuff's happening now, and as that repo number goes from started at 2.2 trillion at 600 billion, it's going to go to zero. Zero is where it started in 2019. Before the pandemic, it was zero. So it went to 2.2. That's exactly the amount of money they printed. Okay, so that money went into the system, keep things going. Now they pull it back out. So the math works where by end of March you should be somewhere around 300 billion, and so as you get closer to zero, I mean 100 billion is basically zero because there's always something moving around in there. But it's like 2.2 trillion was excessive. So anyway, that's what I think the deal is. I mean, like, let me give you an example. I always tell people, they're like, I got a huge tax bill. I mean, I have a huge tax bill. So like, I don't want to be trying to come up with my tax payment March 31st, right? It's like, I don't want to do that. I mean, it's just too much. When I look at this stuff happening, I'm like, I want to be able to chill out, for a few months, because what's going to happen is that when this thing rattles, the market is so heavily traded. It's not stocks. Like, people don't get it. People don't really trade stocks. It's all derivatives. So like if a hedge fund wants to buy stock, they don't actually buy the stock anymore. They buy options on the stock. They buy a synthetic version of the stock. And then dealers have to hedge that. That's what creates all this volume. So you have this giant ball of air. And it's like, when this thing goes in a little bit, everything gets wobbly. So when it's wobbly, you don't want to be like, well, I got to pay for my kids' braces or something. I mean, it's like, you don't want to do that. So, I mean, you want to kind of look at this and say, this is the way this game's being played, is that we have these occasional panics, these like rough periods, very brief. Remember, the COVID thing was like 3 weeks. You lost a third of the value of the stock market in 3 weeks. And then all of a sudden, boom, shot all the way the other direction because of something the Fed did. That's the pattern here. Even 2008, remember, it was like, things happen really fast and then turn. It's not a real market. A real market, you would work through a recessionary cycle. You would work through bank loans and, you just do all this stuff. You don't do that anymore.
Gold prices experienced a significant uptick of nearly 10 points on Monday, rebounding from last week's downward trend attributed to tensions in the Red Sea. The geopolitical tensions, which had initially cast a shadow on the market, are now showing signs of resolution without further escalation. Had the Red Sea tensions persisted, there were concerns about potential repercussions in the U.S. stock market with lasting implications. However, as the situation is de-escalating, gold prices are poised for a possible upward trajectory. In what ways might the recent geopolitical developments shape investor sentiment and influence the broader financial markets? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.